We've all been there. Unexpected expenses, a dream just out of reach, or maybe a financial bump in the road. Today, we're diving into a topic that touches nearly everyone at some point: borrowing money. Whether you're looking to manage debt, fund a dream, or handle an emergency, understanding your options is crucial. So let's explore the various paths to borrowing money and how to choose the best one for your needs. Stay tuned as we demystify loans, credit cards, and more. First up, personal loans. These are a popular choice for many, providing a lump sum of money that you repay over a set period, typically ranging from 1 to 7 years. Personal loans are versatile, making them ideal for various needs such as consolidating high-interest debt, covering major expenses like weddings or home renovations, or funding unexpected emergencies. The interest rates on personal loans can vary significantly based on factors such as the loan amount, term, and most importantly, your creditworthiness. Generally, the better your credit score, the lower the interest rate you'll qualify for. Some personal loans come with fixed interest rates, which means your monthly payment stays the same over the life of the loan, making budgeting easier. Others have variable rates, which can change based on market conditions, potentially making your payments fluctuate. When considering a personal loan, it's essential to look beyond just the interest rate. Check for any additional fees, such as origination fees, which are charged up front and can add to the cost of your loan. Also, consider whether the loan has prepayment penalties, which are fees charged if you pay off your loan early. You can obtain personal loans from various sources, including traditional banks, credit unions, and online lenders. Banks and credit unions might offer the advantage of personal service and potentially better rates for existing customers, while online lenders often provide a more streamlined application process and quicker funding. When shopping for a personal loan, it's wise to compare offers from multiple lenders to ensure you're getting the best rate and terms for your situation. Look at the annual percentage rate, APR, which includes both the interest rate and any fees, to get a complete picture of the cost of the loan. And before you apply, it's a good idea to check your credit score and report to understand your creditworthiness and correct any errors. Finally, remember that taking out a personal loan is a significant financial commitment. Consider your ability to repay the loan, and think about how the monthly payments will fit into your budget. It's also crucial to use the loan for its intended purpose and avoid unnecessary debt, ensuring a financially stable future. Next, credit cards. They're not just for daily expenses. With balance transfers and 0% APR periods, they can be a strategic choice. But beware of the high interest rates post-intro period. Responsible use is key. Considering tapping into your home's value? Home equity loans and home equity lines of credit, HELOCs, are viable options that allow you to borrow against the equity you've built up in your property. They can provide a substantial sum or a flexible line of credit for large expenses such as home renovations, education, or debt consolidation. However, it's essential to proceed with caution, as your home serves as collateral, meaning you risk foreclosure if you're unable to repay the loan. Home equity loans are often termed as second mortgages. They provide a lump sum of cash up front, which you repay over a fixed term at a fixed interest rate. The predictability of monthly payments and interest rates makes budgeting straightforward. However, taking out a large sum means you're committing to a consistent repayment plan, which you'll need to manage alongside your primary mortgage. On the other hand, HELOCs operate more like credit cards, offering a line of credit you can draw from as needed during the draw period. Interest rates are typically variable, meaning they can fluctuate over time. This can affect your monthly payments and the total interest paid over the life of the line of credit. After the draw period ends, you enter the repayment period where you can no longer draw funds and must start paying back the principal and interest. Before deciding on a home equity loan or HELOC, consider the following. Assess your equity. To borrow against your home, you need to have sufficient equity. Most lenders require you to maintain at least 15–20% equity after borrowing. Understand the costs. Beyond the interest rates, there are often fees and closing costs associated with these loans. Make sure you understand all the costs involved. Interest rates and terms. Compare the interest rates and terms from various lenders. Fixed rates offer predictability, while variable rates can lead to lower costs or, conversely, unexpected increases. Repayment ability. Consider your ability to repay the loan. If your financial situation changes, can you still make the payments? Remember, defaulting on these loans can lead to losing your home. Tax implications. The interest on these loans used to be broadly tax deductible. However, Recent tax laws have changed the deductibility of interest, so consult with a tax professional to understand the current implications. Alternative options. Finally, consider alternatives. Personal loans, selling assets, or even downsizing might be more suitable for your situation. In essence, while home equity loans and HELOCs can be useful for accessing large funds, they come with significant risks and costs. Thoroughly evaluate your financial stability, the loan terms, and alternatives before proceeding. It's often wise to consult with a financial advisor to understand fully how these loans fit into your broader financial picture and ensure that you're making a decision that supports your long-term financial health. Peer-to-peer lending is another avenue, offering a more personal touch to borrowing from individuals instead of institutions. But, as with any loan, terms and risks vary. And let's not forget other sources like family loans, pawnshops, and payday loans. Each has its place, but proceed with caution due to potential high costs and personal implications. Now, what should you consider when choosing a loan? Think about why you need the money. Each loan type serves different purposes. Compare interest rates and fees, look closely at repayment terms, and understand how your credit score affects your options. Ready to find the best deal? Start by shopping around. Compare lenders, don't be afraid to negotiate, and always read the fine print. Your future self will thank you. We've covered a lot today, from personal loans to the fine print. Remember, the best way to borrow depends on your unique situation. So take your time, do your research, and approach borrowing with a plan and caution. For more resources, check out the links below, and never hesitate to seek advice from a financial professional. Here's to making empowered and informed financial decisions.